Dougie Fresh in the house.
JC, what's up, man? Good morning.
Dude, best hair in finance.
Happy Prime Day.
Listen, don't listen to what they say about you. That hair, that is really something.
Yeah, I woke up like this. Can you believe
What
it?
are we buying on Amazon Prime Day? What's the move?
My wife woke me up. She goes, "Oh, Prime Day," and starts reading me off things on there. Dude, it was a bunch of nonsense. I think there was like a blue light face mask.
What is
You
that?
mentioned, I don't know, some like UV ray lights that make your face all nice. You put on this mask and it just shines. It looked like a giant gimmick to me.
Yeah, it's a scam.
Yeah,
It's a
scam.
good scam, though. It's a good
I
scam.
didn't see anything we really needed.
Well, do you really need any? I mean, you don't need a lot of things you buy.
No,
So there's
no,
nothing that
no.
like stood out like, oh shit, I'm gonna pick one of those up. Nothing.
No, I mean, listen, I ordered some like men's vitamins yesterday. I wonder if they were on sale today. I'll feel bad if they were. Those vitamins aren't cheap.
So you
I
got
wonder
so
if they're a
you
scam.
I was gonna say you got past the face mask scam, but they got you with the vitamin scam.
100%.
Yeah, yeah,
100%.
got it. Why don't you tell the folks, Doug, new guest on the show, old pals. Why don't you tell the folks a little bit about your day job and through
Sure.
what lens you view the world?
Yeah, yeah. So I'm a financial advisor. I run a wealth management company called Bonafide Wealth. We primarily cater to now your geriatric millennials like you and I here. But we focus on a younger demographic, kind of getting your life started into those higher earning years. I've been doing this for 20 years now. Grew up the son of a certified financial planner to become one myself. So the lens that I typically view all things financially related is a very personal one. We're out here leading with drafting financial plans and creating financial plans for clients, and then pairing that with asset management and helping people be very, very disciplined when it comes to how they manage their money. Probably very boring stuff to those who like trading and being more active, but both have a place in this world of investing. So those are the two things we do: the financial planning piece, very disciplined long-term asset management.
Are you just like a glorified babysitter, kind of?
I think it goes beyond that. I mean, it's very easy to say, hey, let's just do low cost passive indexing and, hang tight. I mean, I think at the core of it, that's what you got to do. I believe a consistent and disciplined investor. And you could say that about active traders too. You got to be disciplined and consistent. You apply that to, either side of the equation here. And that's the bulk of the work. But there's a lot that goes into just maintaining and managing that, right? It's a question of
What about like therapy sessions? Do you get like the phone call like, oh my God, the market's gonna crash, the president, the Fed, do you get like outlandish, random like paranoia, or is it
significantly less out of the younger demographic, because we got
wow?
little kids running around, our lives are busy, we're trying to 60-80 hour work weeks. In my experience, I noticed more of that out of the older demographic, the boomers, who have more time on their
Well,
hands,
they have
right?
more time on their hands to consume all the bullshit news, and they
More
have more to
assets,
lose.
more on the line. So they're, with more time and more in their brokerage account, they can call you up on a Thursday or Friday afternoon and be like, why'd the market sell off today? I also think maybe the era that they've come with, like, this is purebred financial planning here. Our clients don't know any other way to operate that, taking a look at these plans, executing on them, and investing accordingly. 30 years ago, it's brokerage era. It's someone calling you on the phone and saying, hey, I got a great stock tip for you. I think we should, go execute on this position here. And then you're following that one. Less so today.
How do you think about I know it's on a case by case basis because every investor is different. They have different money, different objectives, different ages, all these things. So I get it. Can you just talk generally about alternatives to equities, right? Like
Yeah.
you've got bonds and you've got gold and you've got Bitcoin and you've got, the shit coins and the NFTs and the, right? I don't know how far down you get, but my point is like, how do you think about alternates? And has that changed over the last several years as some of these relationships have shifted? How do you think about that?
Yeah, so you're seeing more people come to the table having messed with things like digital assets. I mean, if you look at, let's talk about digital assets for a second. 5-6 years ago, very, very small minority of clients would be asking questions or have exposure or want to know more about that. And then you get over the last, 3 years or so, and it's much more common. You have prospects coming in the door with pretty significant exposure if they did really well. That's been very interesting. I also think technology and access to the alternative space has really unlocked demand. You can do fractional investing in almost, any all class you want, from art to collectibles, real estate. So, that's been somewhat of a key for giving younger investors the opportunity with lower amounts to purchase with to go into the alt space. So it's been a very compelling argument. Also, just like distrust or skepticism over your more traditional financial systems from a younger demographic is there. So you see that kind of gravitation to alternative asset class. Maybe the future is on a digital space. Maybe it's getting your hands on collectibles and things that really strike at the nostalgia factor. I love 90s nostalgia. There's a lot of stuff out there that I remember from childhood that how many NES cartridges unboxed are fetching premiums now. I'm not saying like a flood of money is going there,
Do
but
you have any?
do I
Do
have
you
it?
have any?
I just want to play that. I just want to find the time to play Zelda.
Yeah.
It is a whole other thing. I'd rather build some Legos and just have some fun. But yeah, that ability to get exposure to these things has never been greater. So you're of course going to see a larger demand there. Having said that, the vast majority of portfolios are still going towards your stocks and bonds, in whether you're starting out with a risk adjusted profile or you're adding opportunity portfolios to that to take various picks of high conviction stock issues, or anything that really is catching the eyes and minds of a younger investor.
Has your thoughts about bonds, I'm mostly interested in the bonds situation,
Too.
how you were thinking about bonds with clients maybe 5 years ago, 10 years ago, and how you're thinking about it now. Has that changed at all or no? Like, do you
Spec-
change durations? You
yeah,
know,
specifically in the last 2 years, it has, and for a number of reasons. So before we've gotten to the current fixed income landscape that we're in, for if you're talking younger clients, you don't have that much exposure to it. So you're talking like maybe an 80-20 portfolio, where 20% bonds are there and being used as a volatility dampener, right? And you want to be mindful of, if you got a high earning client, you're not generating a tax bill just to dampen volatility. So really just to have that exposure, to control volatility, get a little non-correlation between your stocks. But then you get to 2022, where you get the worst bond market in 100 years, right? Like that's a real stat. And you kind of have to take a look, number one, when the Fed was, saying we're going to raise rates, like, you're going to fight that. So I think if you bit down on that, and we did, you went short duration, you went inflation protected, you realize that, like, hey, bonds are going to get crushed. And we don't make a lot of calls here, a lot of active calls, but that was one that we did. That was very good for our older clients who have obviously 40, 50, maybe more percent exposure. You just save them, a drawdown, an epic drawdown on their fixed income portion. Good for us, but you got to get it right twice, right? You got to know how to, go short and then go back long. So I'd rather be early than late on that. So, going back 6-7 months through to today, we make the assumption like rates probably are not pushing too much higher here. And we watch that 10-year throttle, in the upper fours, kissing 5%. And you're like, all right, this is really where maybe we get ahead of the Fed here. They're going to cut rates. I can't see them getting higher. You go back, to the longer duration side and you make that call. Early's fine. You don't want to be late on that. Either way, you've created a massive spread from 2022 into 2024. So I think fixed income is quite the story. And it's a rare environment where you can, hey, I can buy bonds now and clip a nice coupon, relative to the last time we saw rates where they are. You got to go back to 2006. A lot of my clients don't even remember when money markets were getting you 5-6%. Some vaguely do. We were starting our careers at that point. And, you're saying, hey, if I could, buy some bonds, what we get about 5% on good grade, corporate debt. You're going to get paid to hold it. And now what? The Fed's going to lower rates. So you have that opportunity for appreciation there as well. So in the short to intermediate term here, somewhere in there, like bonds look pretty attractive. There's a play to be made there. So, look, if you're buy and hold and, you just got a portion of your portfolio, on in fixed income, and you're not thinking about going longer duration, now's the time to start like thinking about that. If you have too much cash, and I see this too, where clients getting high on the 5% risk-free yield, thinking they're not timing the market, but that's exactly what they're doing. So they're holding too much cash, feeling safe and warm and loving these rates that they haven't seen in a long time. Yet go look at the S&P halfway through the year. So congrats on clipping 2.5% risk free at the halfway point. Meanwhile, as far as just the market goes, you missed 14, 15%. So that's a good lesson for folks who've like really have their first foray into like higher rates or non-zero interest rate environment rates. And again, just a play for bonds here. I'd love your opinion on that, whether you think, they're attractive in this environment, given where rates are and that rates are going to go up. Oh, excuse me, down.
Yeah, I'm from my perspective, from my lens, I don't deal with customers as a financial advisor, so I think of it more selfishly, and I see the bond market as a mess. I see interest rates as a mess. I see the dollar as a mess, and that's good for stocks, right? The
Yeah.
stock market doesn't necessarily dislike higher rates or lower rates. It's more about the rate of change
Yeah.
and the fact that they're just in a range-bound market. The market loves that, and we're seeing it, right? Like, I'm not just making it up. Like, it's been like that for a long time, and the market's just reiterating that is the case. So that's how I see it. And just as a reminder, the folks are like, why is JC asking Doug all these financial advisor questions? Because he's a financial advisor, you see. So I like see a genius move there. So I'm very curious because we have some people that might be active portfolio managers coming in here. Some people are day traders. Some people are swing traders. Some are more bond guys, right? So everybody's looking at the market from a different lens. And I think that unique perspective adds value to the conversation, right? Which is why we're trying to do here. And Doug,
100%.
I didn't just invite you because we're pals. Like, I want you to come in here to share your views. And I'm fascinated by all of this stuff, particularly the alternative stuff. And I want to turn our attention to international markets, right?
Yeah.
So here in the United States, if you've had that home country bias, you've been rewarded for that, because we got a shit ton of technology in an environment where technology is outperforming and other countries just don't have it,
Yeah.
right? You're not going to get any technology stocks in Peru, right? You're not going to get any technology stocks in South Africa or whatever. Like, you got some tech in Israel, you got a bunch of tech in Taiwan, you got some other countries here and there, but it's a US thing,
Yeah.
right? It's a US thing. How do you think, and any time that you've tried, it's particularly you as a financial advisor and others out there, to diversify away from the United States and get more international exposure, you've been penalized for doing that, right?
Yeah.
Right.
Yeah.
So at what point do investors stop being penalized for expanding globally and start to be rewarded for that?
Yeah. That's a really great question. And, you look at like, take that Ibbotson
I
chart
thought
that
so too.
Yeah, you take that beautiful, colorful Ibbotson chart with all those squares, and you go back far enough in time, and you'll see like emerging markets be at the top of the stack for many years. Like, if you're gonna go out there and take the risk, you got to get the premium. So you go back in time, you're like, that can reward me. Even developed international has popped up there, and then you get over the last like 8 years, and it's just nowhere to be found. Like, large growth, just absolutely obliterating anything else. If you think long term enough and in cycles, you have to have this belief that we're going to live, over the next 20, 30 years at a time where we see international peace climb back up. It's hard for me to think like we'll exist in a world where it's US large cap all the way. Having said that, you look at risk. I keep coming back to this 80-20 portfolio as just our example of a risk of risk adjusted. What do you got? You got 20 to 25% in developed. And then you got maybe 7 to 9% in emerging markets, and you go up to the large cap growth area, or excuse me, just large cap in general, and you're 35 to 40% there. So look, it's weighted appropriately. It's not like you're really shitting the bed for having exposure to international. There's also flavors of international that you could take. Shout out to my friend Perth, who runs.
Oh, you nailed it! I literally just pulled up the chart. Throw up slide 2 there, Spencer.
There you
I
go.
was
Oh my
literally
God.
about to ask you. It's a mutual friend of ours.
There's Perth. She's awesome, and she created the Freedom Fund. We use this in, this is our EM fund, and you've been rewarded for taking a story that is, I am going to focus on emerging market countries that treats their citizens with a degree of freedom. You look at how they're treating people. I mean, there's no China in here. There's no Russia in here. You look at an emerging market, index, a standard emerging market index. I think you got like 30% exposure to China. And here's a story that's playing out well. No one's going to be disappointed with that breakout right there on the EM space. And you compare that, it's getting points ahead of just your regular core emerging market indices.
And
So
no India, no India here.
no India.
Do they treat their citizens poorly?
No, it's interesting. It's not binary, right? You can go to her research to see how they filter these things. Like, you go to countries where clearly they treat people wrong and you're not going to find them in the index. Like, how do you adjust for a Singapore where like they will take care of you cradle to grave, but don't spit in the streets. You're going to get, whipped or caned for that, or
I'm
at
just
least really
surprised.
told growing up.
First of all, I'm surprised that there's. I'm looking at the top 10 holdings in FRDM
Yeah.
as of the close of Q2. No India,
Yeah.
and the ETF, no China either. But India in particular stands out because India has been so dominant in terms of its
Yeah.
performance that this index is making new all-time highs coming out of a multi-year base, despite not having any Indian exposure.
Wild.
I think that's very impressive.
It's super impressive, and again, she a good friend, and hats off to Perth because she's absolutely. I was there when she launched the ETF downtown. It was really cool to see that. I wish her all the success in the world. But here's an amazing story that's playing out well in client portfolios. Because listen, you say, are we just babysitting? I could have picked any emerging market core index, and just said, cool, we have exposure to emerging markets, or we can do some research and find out what maybe the best story around for clients. So is that considered active management? I mean, to some degree, yeah, we're actively selecting, which fund should be in a client's risk adjusted portfolio. There's
So
always
hold
this
on,
joke
Doug.
like,
Doug, this is your EM fund?
this is our EM play for the last maybe couple years.
Wow. Well,
I
that's
I
good.
I grew personally, and this is where our view as advisors can come through in terms of how we allocate money. I was tired of seeing that 30%, primarily that 30% exposure to China, whipsawing EM portfolios back and
Yeah,
forth.
but Doug, you wouldn't be complaining about that if China was ripping.
No, but I'd have to make the choice. Do I want this long term? Oh, it's ripping what, over a year or 2 years until another ghost city implodes? You have to have some say and some view of how, the world works here. And I said, I'm kind of tired of that. I would prefer that not to be here. And look, there's even a trade-off. I don't get India exposure, right? That's something. But you can add an India fund to
You
your
can add an India fund, right?
you
Because
can
it's a
add an
bummer
India
not
client
having
says I really
India.
want that exposure. You can throw it in there.
Yeah, no, I get that. Love that. Absolutely love that. We got to get Perth back on the show.
Yeah,
Maybe we'll get Perth and Doug together. That would be fun.
that'd be cool.
That'd be cool. All right. Why don't we talk about commodities, please?
Yeah,
Commodities. I'm old enough, and you also, as your gray hairs can prove, that you were around also during the last commodity super cycle, during the last bull market. So you've witnessed this. The kids these days, they don't remember when gold used to be cool. They think gold is just boring for old angry people. Like
yeah,
being a gold bug was cool, 15, 20 years ago, right? Not so much 15, more like 20, 25 years ago. Damn,
yeah,
I'm
yeah,
getting
yeah.
old. How do you think about it? Gold making new all-time highs literally as we speak. What about things like copper, crude oil? How do you are there ETFs are tough for commodities, right?
Very.
Unless you're commodity specific, and even then it's not great. How do you think about a commodities natural resources sleeve?
Yeah, look, you're looking at the hard. I think you're right. I think it's a very difficult place to be, especially as a passive investor. You also think
Which,
about
by the
what
way, makes me more bullish because of how hard it is to get involved. Keep that in
Yeah,
mind.
I, th-
When
I
there's a
think
hundred, when there's 1,000 ETFs, and there's a new commodities ETF coming out every day, and the leverage ones are dropping, we're probably a little later in the cycle. The fact that you can't even find a goddamn ETF to invest in commodities.
Yeah, yeah. I mean, it's just like how they function. I mean, it's a hands-on play. Like if you're really going to dive into that world, people usually, from my perspective, want commodities exposure as an inflation hedge, or they want hard assets, or they want non-correlated returns, and they want that as like a sleeve in their portfolio. It's just hard to be like, hey, let's allocate 5% of $1 million portfolio to commodities and be like, all right, this is really doing something for us here, as opposed to the folks you're probably more familiar with who know how to play this area. It's not a huge part of how we allocate because I believe getting the exposure that you want takes more effort, and it's not that we don't have the ability to do it. So we got to scale that ability across a financial planning practice. So it's not really something that's been in like our our target for the most part. And when you look at the demographic that we serve, I'm getting more, requests around Bitcoin and Ethereum and digital assets than to your point, like the young kids don't remember a day it was cool to hold on to gold and precious metals. And that's like what you were allocating to when you're like, I want my commodities fund and exposure in my portfolio. Today, people are like, and speaking of like ETFs and commodities, like now you have Bitcoin ETFs. So even the
And
boomers
Ethereum
can get
coming
in.
around, and Solana around the corner too, probably.
Yeah, they're coming right up. There's no reason you're not going to see that in short order.
Do
So
you
whether
think
you just
about
don't,
that? Do you think about them as commodities, or you think about it as more tech?
I think you split the ticket here. Probably less commodities, more tech, but also like I view Bitcoin as digital gold. I know it's cliche almost to
But
say
what
that
about
at this
Ethereum
point.
then?
Yeah. Say again.
What about Ethereum?
Yeah, that's more the technology play to me. Like,
So if Bitcoin is digital gold, Ethereum's not digital silver.
no, it's not. And that's why when you get that like technology thread running to it, it could permutate in a different direction. Not to offend the silver and gold bugs out there, but rocks are rocks. I know they're more than rocks, but it's a thing. It's you can touch it. You can't touch the blockchain.
Dude, gold bugs hate it when you call them rocks. They
I
are.
know
It's a
they.
mineral. It's a
I know.
mineral,
I
JT.
apologize, guys. I have no hate for any asset class here. I want you all to make money.
Um, why don't we talk about psychology a little bit before we let you run? You are quite the observer of human behavior, right? You have to be. You talk to investors a lot. My suspicion is you've walked a couple of people off the ledge at times throughout your career. Um, what role do you think human psychology plays in the market? And then just from a personal finance standpoint, being able to recognize your own flaws and your own biases and trying to overcome that to accomplish your ultimate goals. Like, how do you think about all that stuff?
Yeah, you have to learn from events as you go. I think what's hard for young financial advisors is they don't have the experience of living through cycles and they don't know necessarily how to approach. But then you're also met with it's psychology to the tune of every individual client. So I'll give you a good example here. I cut my teeth and moved to New York City a few years in as a financial advisor in October 2008. So literally the first like year and a half of my career in New York City as an advisor is working for a practice that's primarily pre and post retirees. You can only imagine how the phone is ringing off the hook from October '08 into, mid of
Yeah.
2009. And I take this as probably the best learning lesson of my career. We were very successful, at least I was very successful in talking those clients off a cliff. Humor is part of what I do. Like, dear, Mr. and Miss Smith, if you really think the wheels are falling off here and this is the end of times, are you going to be calling me next week, wondering, how we get money? We're all on the roof protecting, our things with guns and Neosporin. And you take this environment as one of the biggest learning lessons, and then you're like, all right, as an advisor, I can look back at this and realize that there were opportunities there. Like, how would we have successfully navigated a client in the depths of March '09 to actually take cash if they had it? Now, what was interesting about '08, '09 is financial crisis, unemployment, is what's really preventing people from tapping cash or rotating assets, into more risk on assets out of their bonds and stuff like that. But then you're like, there will be a moment again where, this happens. And the whole time I'm thinking it will be another financial related one. And sure enough, it's not. So now we're in 2020 and it's a health related crisis, right? It's COVID, but yet you're still got your wits about you. Like, hey, I got that learning from '08. Here we are in 2020. How do we get clients' head around the fact that we are on a 33.5% drawdown on the S&P 500? We should probably bite down on this. And you lay out the roadmap, you best intended plan. You say, let's take these lessons and make this happen. And you're still met with, I don't know if daycare is opening tomorrow. I don't know if my job's going to be there tomorrow. I don't know if we're all going to be around tomorrow. Worst case scenario. Doug, I love you. I'm not going to sell. That's the main goal. Like, don't sell at the bottom, right? If you're a financial advisor advising clients and there's an epic drawdown like that, your number one goal is do not sell this bottom. You will never recover from that. And at the very, very least, just rebalance your portfolio here. Go scoop some stuff up here. But how do you go out to home plate, third base here, which is do we take 3 months of our cash reserve at a precarious time, or do we rotate out of any fixed income into those cheap equities? And that's so hard to do. I was expecting a double the amount of clients that actually did it. I was glad a lot followed that. They're not regretting the decision to do that, but it's extremely hard. So yes, a lot of this is about psychology. I think that's where financial planning comes in. When you give people a basis and a roadmap to follow and stick to, they're going to do a much better job at sticking to their plan than shooting from the hip or panicking or getting their emotions, all involved into their investment strategy. That's the number one killer. Full circle moment. Discipline, right? And consistency is what separates okay and good investors to the great investors. And if you have that and you enter environments where things are wild and things get scary, you can find someone who's going to execute and take advantage of the situation in the context or in the confines of their own financial plan. Like even 10K in cash, 25K in cash at that moment is going to add points, to your overall annual rate of return, which when you're doing planning, what annual rate of return you're trying to achieve over a long period of time. And it ain't a double-digit number.
And a couple of points here and there really compound big time. And if you've done the math, you know that.
Yeah. Yeah. Like you get that percent. You create that. Same with the fixed income thing we were talking about. You save an older client on 40% of their portfolio, classic 60-40. You see a 14% drawdown in fixed income and you gave them a 4% drawdown. You gave them a 4%. That's a 10% spread. Holy crap, man. Your plan's going to, when
You're a
you
hero.
revise that financial plan, it's going to look fantastic.
Yeah. Are you eating a lot of your own home cooking, or are you
All the
veering
way.
off and doing a little bit of your own thing? Like, how do you think about what you do for clients versus
Yeah.
what
Yeah.
you do for yourself and your family?
Absolutely. Let's go 80-90% of what I invest in is my own cooking, just dollar cost averaging into the main indices. But in the retirement account, I'm always a fan of there being an opportunity portfolio. I have zero qualms with someone saying, let me take 10-20% of my investable net worth. I believe in X, Y, and Z. I was lucky on the NVIDIA trade. I'm like chips. I grew up with computers. That seemed like something to do. And there's losers in there too. Like, my wife and I are like, lockdown, Peloton's going to take over the world. Got a 3-bagger, full circle back to, 90% drawdown. So, a little bit of picks here and there. We were early adopters of Bitcoin. We mined Bitcoin back in 2010 from a friend who wanted to just mess around with it. We learned a ton, made out pretty well on that. Not enough to retire, but big believer in blockchain. And, I think Bitcoin, love to see it kind of going mainstream here. That's been a highlight. But when it comes to just
Is it
fresh money
mainstream,
going,
you think?
you got to, when you got Larry Fink out there, spitting out high conviction around
I was
Bitcoin.
surprised nobody mentioned it in the debate.
Yeah, not only in the debate. Well, I think you're going to hear a lot more of it after yesterday's VP pick and kind of this pro
Yeah, because
crypto
he's long. He's
stance
got like
coming
a
out of the
$250,000 in
GOP.
Bitcoin, right?
Say again?
He's got like a quarter million dollars in Bitcoin.
Yeah,
This
he's got a
guy,
quarter
Vance,
million. He's
Bob Vance.
ingrained in the like hard to talk about the VC world without getting some conversation around digital assets and building in that space. So we're definitely going to hear more of it. And yes, I do think we took a big step towards mainstream, but hard to say something's mainstream. It's only been around 15 years in the world of finance. We got asset classes that have been around 100 years. So perspective really comes into play here.
If you are a 42-year-old male with real estate and equities portfolios and a family of 5 with 3 children, a 3-year-old and twin 1-year-olds, what percentage of your portfolio in this hypothetical situation should one have in Bitcoin?
How much you have in Bitcoin? I mean, as the advisor in me is no issues taking 5-10% of your investable portfolio and pursuing something
10%
like
of
that.
the portfolio in Bitcoin?
10% up to, I wouldn't go there, but that 5% sleeve sounds good. You love these charts that are like, here's what your portfolio would look like 1, 2, 3, 4, up to 5%, over the last 10 years. That chart always shows a very compelling story for having
Well,
some
yeah,
exposure
thanks.
to it. But I think, when I say 10%, when I talk about, we're talking about concentration risk. So clients all the time come in with concentration risk from their RSUs and exposure from their company. And, if they hit a home run at their startup, or they're just at a mega cap that pays a good portion of their compensation and they're doing great within 3 to 5 years, they have concentration risk, right? We're seeing 20 to 40% of their portfolio in their company stock, and they need to have a plan for that. For the ones that like, hey, I don't want to sell all of this because I think we could double or triple, you got to figure out what that sweet spot is. So concentration, I never want to see more than 20% of anyone's portfolio X their personal residence, X, S&P 500 and the index. I really don't want to see any more than 20% in one singular position before you start seeing, returns in your portfolio value get dictated by that one stock. And that's very relevant for people who struck gold with Nvidia or any Mag 7 stock where they're like, shit, 50% of my portfolio is in two positions or one position. How do I deal with that so I don't, lick my wounds when that next 60% drawdown comes?
I got one more question. How do you think about like vacation homes? You got your primary resident, you got your liquid portfolio, you got your retirement stuff. Like,
Yeah.
where does like a second home fit into that situation? How do you think
Yeah.
about that?
I think about the objective of that home, right? So let's break it out into people who just want that in their family, doing this right now with a really good friend and client. They're looking upstate for that, that upstate cabin, if you will. And I asked, is there ever a moment where this is going to be generating income for you? How are you going to be treating it? He's like, no, generations to come. I want the kids and the grandkids and all of
Yeah,
that.
right.
So
Me
I treat
too.
that like an asset, right? Now you have exposure to, real estate here. We're going
So
to
just
think of it
add
like,
that to the value of your home, I guess.
well, it's funny because I
Like,
view
is
your
it part
personal
of that, or is it part of the like alternative investments?
the
Like, how does
alt,
it
yeah,
work?
I'm gonna push it more to the alt space. If you're saying
Yeah,
like, hey, I got $1 million cabin, upstate in the mountains there, that's now a real estate asset. It then morphs again if you're like, hey, I'm gonna put a renter in that 6-7 months a year and enjoy it. Now you got an income producing real estate
sure.
asset, and you can think of it a little differently. And both of those are very different from how I think about your personal residence. Like that's on the balance sheet, but I don't even view that as a retirement asset.
Yeah,
That's a memory factory to me. Good luck calculating your ROI on your primary residence. You're gonna log every nail and tack you've ever bought. Dude,
right.
enjoy it, beat it to death. Keep it. Go have go create those memories. And if you walk away, if it's your forever home and you walk away 25, 30 years, like the boomers are today with, cash in their pocket, well, how much of that cash is really profit? Good for you. I hope it's enough to then, go to the place you want to retire. Or maybe you're just going to be a renter at that point and not have to deal with home ownership. The kids are grown up and you just want to go travel and stuff like that. Yeah. So it's unquantifiable. That's right.
But I like how you're thinking about that on the alternate side. So you got your residential real estate, you got your liquid portfolio, then you got your Bitcoin and your beach house, right? So like
Yeah.
Avalon, beach house, and Bitcoin. I wish the houses there were only a million.
Yeah,
But
it's insane down there. Yeah, we were talking about that. We'll be back there later this summer, but you
dude, I
can't
was there
even
for
like
a
talk
month.
just
It's
the
freaking
$3 million
awesome, man.
starting point. It's insanity. I don't even know how. I
Dude,
don't
it's
even know
like
how
three
you get
million
in
just to
there,
get on the island for
dude.
like the shittiest, smallest house. 3 million, dude.
Easy. Yeah, Margate's the same way. Longport, South Jersey Shore, just the South Jersey Shore, blow it up real big there. But yes, and when you start to add up those things, like you got that Bitcoin exposure, you got that second property in your portfolio, you add up all the other, stuff you're messing around with in the alt space, you start seeing like 25-30% of your investable net worth or your net worth like allocated to alt. So back to what you said earlier, like how much are you seeing that? As you mature into building wealth, you find yourself, with more in alts. And, you look at the big endowments of the world, like the Yale endowment, and you see how much they have in alts. It's like 30, last when I was in business school, they had like 33 to 40% in the alt space. So you start to model these like really institutional portfolios at the personal level. I will say though, if you go your entire investment career as a personal investor, and you're like long mostly equities and you're consistent of of getting money into the market, it's an amazing compounding machine. You know what your goals are, you have a plan to get there, and you just want to be a disciplined equity investor with a sprinkling of fixed income and ignore everything else. You probably are going to do just fine and
Yeah.
crush it. That's the great, because you're disciplined and you're invested and you're doing what you got to do. That's what's so cool about investing. So many ways to get this right, also a ton of ways to get it horribly wrong.
Oh yeah. Yeah, we see that all the time too. I love how this turned into like a consultation for me. Doug. I really appreciate
come
that.
on down, man. We got you. We got you
I'm taking
covered.
notes. Taking notes.
Guys, I dropped the link tree for Doug in the description. As I mentioned, tremendous follow on Twitter, but all his links are in there. So check it out if you haven't already. Doug, this has been fantastic. Thank you so much
Thank you so much.
coming on today.
Yeah, no, I love being here. I'll be honest. I was like, oh my God, I'm going to have to talk about specific issues and stocks, which is, really out of my wheelhouse other than, what we all follow online. So I really appreciate you diving into like the core of what we do and getting to pair that with, some really great commentary around how we think about investments. This was awesome. What a way to start my morning, guys.
Love it. We'll do it again, Doug. You and Perth together, and we'll get down and
that would be cool. Yeah, I would love that. She's fantastic.
Yeah.
Get her back on here.
Love it. She's in Texas, right?
I think so.
All right.
Good question. I only see her when I'm in New York.
I know. Or California.
Yeah, true.
Yeah. Cool. By the way, Thursday, Fide drinks.
Awesome. Try and get there.
Yeah. Stone Street. I think like 5 o'clock or something.
Let's do it.
Cool.
All right, guys.
Adios.
All right.